Good morning, everybody. I hope you can hear me. If there's any sort of technical audio issues, please write in the chat box. Thank you very much for all joining us today, especially on a Monday morning. I know everyone is very busy with everything going on. Today, we're joined by Andy from Standard Life Technical. He joined Standard Life 2 years ago and has over 30 years experience in the financial services profession. He leads a team of highly experienced technical consultants who work with advisors across tax, trust, retirement and estate planning. The current legislative and regulatory environment for financial planning is very complex, and Andy is definitely an expert in this field. The key is to know what the legislation says, and then to look at, so what does it really mean, part of it. The focus is on identifying and communicating change and the opportunities this presents for advisors and their clients. Andy's previously worked in a number of advisory, relationship management, technical consultancy, and management roles. He is a regular presenter at local, regional, and national financial planning events. And Andy has been married for over 30 years. He has 2 children in their early 20s. He still believes he is the bank of choice. Any time outside of work involves spending time with his family, traveling abroad, and golf. So I'll now hand over to Andy. And if you do have any questions, please write them in the chat box, and we will come to those at the end.
Thanks very much. Thanks for the introduction. Today, been asked to look at a couple of aspects, a bit of a budget update. I think it's worth just referencing back to some stuff that happened on the 11th of March, and then to look at some planning opportunities in the current economic climate. As was said in the introduction, I've been doing this type of stuff for far too long now, but over 30 years. And there's a couple of things that always are worth saying. And one is, tax planning never stops, irrespective of the economic conditions that we're facing, whether the market is going up, coming down, is volatile. There are always tax planning opportunities for clients that present themselves. The other thing that's really important, and I always kind of bring out as context when I'm doing presentations at the moment, is, and I say this genuinely, in the 30 years I've been doing this, this is the golden age of financial planning. If you think about the flexibility that's available to customers and clients now at every level, it just is exponentially more than it used to be. An example I always use is that when I started a long time ago, I worked for a company called Clerical Medical. And they had a pension policy that at the time became very flexible because they offered 3 fund choices. And I mean, we were blown away that we could offer a client 3 fund choices. And that was cash with profits or balance managed funds. And then they added 6 external funds, which made it just an amazingly flexible personal pension wrapper. But that was 30 years ago. And if we think about what you can offer a client today inside a pension wrapper, there's thousands of different investment options. So flexibility is huge. We've got flexible tax wrapper choice, mainstream, well-known. They've been with us for years. Tax wrapper choice for clients now is huge. The flexibility that they've got, if you think about a modern style DC pension, if that's not the most flexible vehicle in the world, where you can take between 1 penny and every penny of your pension pot at any day of the week, that's flexibility. And then we've got a tax environment now, when you look at basic rate tax, all the allowances and exemptions that you can stitch together incredibly flexibly now, producing different types of income to get fantastic tax results for clients. So that's my kind of context. The other thing that I will say is there is a lot of opportunity, but we're also in a really interesting position at the moment because we've had Brexit, we've had an election, we've then had a budget, we've had COVID-19, and we know that we're facing into a budget in November, where there could be some quite significant tax change. So again, giving advice in the current economic climate, the current flexible environment, and looking ahead to what may happen is incredibly complicated. So that's my kind of introduction and preamble. There's some learning objectives for the session, post-budget planning opportunities, because again, tying into that whole theme of flexibility, there's some great options now for clients, but there's 1 or 2 caveats around that as well. There's 1 or 2 things we need to look out for as professional advisors and planners. to make sure clients are doing the right thing. And again, against a backdrop of a lot of clients that are kind of, to me now, in my experience, choosing to self-serve. And I think there's a lot of clients out there who are thinking they're doing themselves a really great service by self-serving in certain areas, like probate, for example, when actually the advice of professionals would put them in a much better position. Current opportunity for IHT planning. We've seen a market correction, but the IHT options out there and the opportunity for clients to think about that now, particularly facing into legislative change that may come later on this year, I think now is an ideal time to be reinvigorating some conversations or engaging with some new clients who haven't actually thought about this at the moment. And then looking at tax wrapper decisions. So plenty to talk about. Firstly, I just want to quickly talk about pensions. I'll show you a slide later on which tells you why I'm a huge fan of pension planning for clients. It is one of the best tax planning opportunities in the UK, and that's why it's coming under such significant scrutiny with the cost to the exchequer of things like tax relief and that type of thing. But it does generate a lot of tax revenue as well with people in retirement in that decumulation phase. The lifetime allowance, two quick things I would say about the lifetime allowance is that we need to consider lots more clients now as to who could be affected. I always imagine the wealth in the UK as a pyramid. I try and think of things visually. And when the lifetime allowance came out in 2006, it affected the very few people right at the peak of the pyramid. And it was going to grow, and then it plateaued, and now it's fallen significantly. And if you bring the lifetime allowance down, the base of that pyramid, the number of clients that are caught becomes exponentially bigger. And we're seeing hundreds of thousands of people now caught by the lifetime allowance. It went up by CPI. The 2 points I would make are, will that LTA still be at that level after the budget in November? We don't know. But thinking forward, are there a couple of things that we could do for clients just to make sure that some people take advantage of this level of lifetime allowance, but also what might happen in the future? Clients can register for protection from the lifetime allowance, and there are still a couple of options where the clients can still register. The one I would talk about is fixed protection 16, where if you've got particular clients that haven't accrued any pension benefits post the 5th of April 2016, they've had no relevant benefit accrual, they've paid no contributions in, they can still register for fixed protection 16. Now, why would you do that? I call it back pocket FP16. It takes about 10 minutes on the government gateway maximum to register for this protection. That would give the client protection at 1.25 million. Their fund might only be worth 800,000, 900,000, 700,000. But if there is legislative change in November, having that back pocket FP16 could be a great piece of advice. So just identifying some of your clients that aren't paying into pensions anymore, why not get that FP16? There were various other things that happened, smaller things in the budget. The annual allowance remained the same, apart from one group, which I'll talk about in a moment. Very important that we do the correct type of engagement with those clients, and that's around the tapered annual allowance. The standard annual allowance remains at £40,000, and if you've triggered benefits flexibly in the new pension freedom regime, you could be caught by the money purchase annual allowance, which is only £4,000. So advising clients to not trigger that is another huge piece of advice. And identifying clients who want to take benefits, we need to consider the money purchase annual allowance. There are a couple of other small parts. There's always been a problem in the UK as the personal allowance, this flexible personal allowance that we've got now, very generous, £12,500, but there's lots of low earners who are caught in a trap where if their pensions are paid in a particular way, they don't get tax relief. But if they make a personal contribution under relief at source, they do get basic rate tax relief. And the government is committed to deal with that anomaly in our system. They've issued a call for evidence to make sure those clients do get the benefit of tax relief in some way. And there's a number of suggestions as to how that might work. Just linking back to the standard annual allowance, £40,000 fully tax relieved into a pension scheme is a very generous allowance for a client. And if you take that across a couple, that's £80,000. And if you put in their ISA allowance as well of £20,000 each, that's £120,000 worth of effective tax relief savings these clients could make each and every year if they've got the ability to do it. Is that something the revenue may look at in the November budget? Who knows? The big change was around tapered annual allowance. And again, you need to just start thinking about people that this could have affected, because there were a huge amount of clients that this affected. And it was really brought to light by the emotive issue of the NHS. That brought it right into the public domain, really, with the kind of clinicians, consultants, GPs who were being caught, by the lifetime allowance level, and also by breaching the annual allowance level, because what was deemed to go into their pension was over this limit. They were high earners. They were being tapered down to £10,000 worth of pension contribution as an allowance, and they were getting big tax bills, and lots of them were not taking on extra shifts. Very emotive, particularly facing into what they thought was going to be a cold snap over this winter, and they needed the NHS fully staffed. And then, of course, we got COVID. So very big issue. Dealt with, I have to say the scale of change was I didn't expect them to do what they did, which was to increase the threshold income limit and the adjusted income limit by £90,000. And another small tweak they put in was to bring the minimum annual allowance down from £10,000 to £4,000. So you've now got this band of adjusted income between £240,000 and £312,000, where the client will be tapered down on a one-for-one basis, and they will be fully tapered down to £4,000 now, not 10. So it said in the budget blurb, if you download this stuff and read it, the devil's quite often in the detail. I do read this stuff. I quite enjoy it. I'm quite sad, but I do read it. And in there, it said that this lifts 95% of clients who were affected by tapered annual allowance out of the annual allowance trap. Now, if that's true, the kind of question I had in the back of my mind was, why not just scrap it altogether? Why leave it in for a very small group of people right at the top end of earnings who probably have dealt with their pension position already? It just seems a bit ridiculous to leave in this really complex calculation right at the top end. As an example, you know how tapering works. The big issue, though, is who do we need to think about? This table just sums up the significant change to the threshold and adjusted income levels and the minimum going down to 4,000. More relevant here, I always focus on the middle line on this table, which is Lauren. Lauren, in the last tax year, had adjusted income of £220,000, so was fully tapered because she was over the £210,000 limit, fully tapered down to £10,000. Now, this year, not tapered at all because of the increases, and her ability to pay into pensions has quadrupled. Again, giving huge flexibility to put money into possibly the most effective tax relief vehicle in the UK. And for certain clients, that has presented some opportunity. So any client that was affected by tapering, we need to have a conversation with them because they took one of a few different routes to deal with this issue. Some of them opted out of pensions altogether. And if clients have opted out of pension because they felt £10,000 wasn't enough to be putting in, they can go back in and they could possibly sweep up and use carry forward to put in £70,000 this year. That's a significant contribution to their pension scheme. If they'd reduced their contributions, they need to think about potentially increasing them. So anyone who opted out or reduced, anyone who's got any carry forward they could use, particularly linking in, as I say, with that context around what may change in the budget. Will we still have higher rate tax relief in 12 months, 18 months, 2 years? Who knows? Why not take the advantage with the carry forward with that additional wriggle room they've got now with pension planning to get the money in? Anyone who's above that kind of level, £312,000, very nice, but need to consider non-pension funding or non-pensions and funding them to make sure they've got that opportunity to create tax-efficient income in retirement. And that's quite a simple thing to do with those wonderful allowances that we've got available now. So lots to do in the pensions world. It kind of starts to move across as well, and this is something you'll be very familiar with, but a big change for financial planning for business owners was the change to entrepreneurs relief, and this ties in with pension planning as well. Certainly up until 2015, a lot of people were building value in their businesses, and quite rightly. It's a great income generator on the journey. It could be an income generator in retirement, or they could be considering business sale. And when you had entrepreneurs relief and £10 million worth of gains taxed very attractively at 10%, building value in the business is a superb thing to be doing. But we've seen the revenues start to tighten down on qualification for entrepreneurs relief in 2018, trying to make sure the corporate structures are being used appropriately for generating trade and GDP, jobs, employment. And then in March this year, we saw a massive cut to entrepreneurs relief. They took the opportunity to change the name to business asset disposal relief, and I'm not quite sure why they did that. But business asset disposal relief now just at £1 million. I say just, but for certain clients who are building value in their business and relying on that as their kind of pension or income in retirement, this sale, that's a significant increase in their tax rate that they will pay. Any gain over £1 million now taxed at 20% at a higher rate. And if again we think forward, Rishi Sunak in the last couple of weeks has issued that letter to the Office of Tax Simplification, and he's quite specific in there that he wants a full review of the capital gains tax regime in the UK, talked about very robustly in the run-up to the election by lots of people. We know there's change due in that area, and there's a lot of talk about the alignment of tax for capital gains with income, which would again double the higher rate from 20 to 40. So business owners who were looking at a 10% rate on £10 million worth of gains could be looking at a vaster tax bill moving forward, which starts to bring in that kind of opportunity to diversify their wealth away from the business potentially by extracting profit in a tax efficient way and utilizing pensions now, which is gives them a bit more freedom in the planning, as you will know, with those upgraded threshold and adjusted income levels. This slide is just showing for somebody with £10 million, their tax bill pretty much doubles with this one change in legislation. If we see change to the tax rate itself, who knows what that bill could be as we face into a business sale next year. And again, whenever any tax rates change, we as a profession, working with other professions, kind of sit there and look at profit extraction. Do we go down the salary route with dividends? Do we go down salary and bonus? Do we look at pensions? How do we blend it together? And you will have seen this slide before, but the pension becomes, and it is the most tax efficient profit extraction vehicle where the client has got additional profit. They don't need it from an income perspective. Getting into a pension now with those relaxed rules about getting it in currently with higher rate tax relief is very effective. It would be wrong of me not to look at the tax journey in total and what's the benefit to the client at the other end, because we know that the pension is going to get taxed later on. But the point I'm trying to bring out here is diversification away from the business. And then from a tax perspective, we know that post-pension freedoms, this vehicle is incredibly effective as an intergenerational wealth transfer tool. And if the client needs to draw that flexible income, we can use these amazing allowances and exemptions and the high basic rate tax band and spouses allowances and everything to take money from the portfolio very effectively. And looking at any tax rate on there, it's still very efficient, even after additional rate tax, to pay money into a pension scheme. It's just an intro. I saw some stats recently that says if you are accumulating pensions as a higher rate taxpayer, what is the statistical likelihood that you will still be a higher rate taxpayer in retirement? And I'd like to point out this is before this huge big shift towards DC pensions and flexibility. And they reckon it's 15% of people who are higher rate taxpayers in the accumulation phase will actually be higher rate taxpayers in the decumulation phase. So we can take from that most people will be able to get down into basic rate tax, control their tax timing, become basic rate taxpayers and get significant value, as you can see on the slide there. So pension versus dividend is something we're all involved in with clients, but it's just a time to step back, I think, and just consider the options every time there is a tax change. And this tapered annual allowance gives additional opportunity for business owners, particularly because they can control their threshold income by their salary dividend structure. So it's all about, as the bottom bullet point says, getting in shape for retirement, maximising that funding, diversifying the risk away from the business, tied in with changes to corporate taxation, business asset disposal relief, all that kind of stuff to make sure the client is in the right place at the right time to take advantage of any future change. I kind of threw this slide in here, and this is something you will be well aware of, but it's worth just kind of talking about because, again, to me, it draws out the point that I've made before, that the revenue are keenly interested in all sorts of tax allowances and reliefs at the moment. And they've actually set up a special investigation unit looking at kind of family office, family investment company type structures, which we all know are very effective. They're really good vehicles in the right circumstances, but we need to keep a keen eye on what the revenue are going to do in that area. It says in there, and this is from their statement, that they're looking at a review into tax risks associated with these types of structures with a focus on inheritance tax. And in the back of my mind, I just think about what could happen in November, because we've got all of those consultation papers which are stacked up and waiting. We've had the Office of Tax Simplification IHT review, 2 papers which have given some significant recommendations in this area. We've had the All-Party Policy Group paper in January, which again, MPs looking at the IHT regime and making a series of kind of recommendations for consideration for HMRC. So all of this stuff is tied in together. We know that they're keenly interested in the use of business property relief and agricultural property relief and normal expenditure out of income. All these types of things are up for discussion. One point, just very quickly, I would make on this slide is, again, it's a post-budget thing, but it's just discussing things with clients in context and you know, the real world. The ISA limit stayed the same. I referenced that earlier. £20,000 plus your pension contributions for a couple gives you a huge amount of opportunity to save in a tax efficient vehicle. ISAs, we need to think about IHT at the decumulation end because they're not IHT efficient. So do we need to do something different at that point? But the one I wanted to pull out was just junior ISAs, child trust funds. You know, the limit was increased, it was significant, it more than doubled, and that's fantastic. And I love ISAs, they're great tax efficient vehicles, particularly in the accumulation phase. But if we look at that journey, if we've got a lot of people now, and it is a real shift in mindset post 2015, that people look at intergenerational wealth transfer in a very different way now, and lots of people are really thinking about pushing the money down the generations, this wealth that's accrued in the generation that are retiring at the moment. And people look at parental or grandparental savings, which is wonderful. But you've now got this limit in a junior ISA to pay £9,000 a year. Under the old rules, you could pay in, if you did it for 18 years while the child was getting to their majority, you could put in 78,600, so which is fantastic. And you've got growth on that. If you did £9,000 a year under the new rules, you'd have £162,000, which is it's a huge sum of money, plus growth. So we could easily expect that to double in value. The downside is, as it is with normal kind of bare trust planning, the child gets complete and uncontrolled access to that money at age 18, and that is quite an emotional issue, which I think is worth talking to these clients about, because there's lots of other structures we can put in place from a savings and a trust perspective to give the tax advantage that you could get in a junior ISA, but also to give the control around that, interesting age, 18-year-olds coming into their adulthood, where they could be given a huge sum of money. So it's just a note of caution. There's lots of opportunity there to give some quality advice, to discuss this kind of situation with the clients, to make sure they're making an eyes wide open decision about giving this money potentially to that child at age 18. Very quickly, don't want to talk about this to any great degree, but life assurance bonds, capital redemption bonds, chargeable gains have been hugely in the spotlight over the last 3 or 4 years. And I've certainly been involved in quite a number of cases where there's been some significant tax bills for clients because they've inadvertently lost their personal allowance in the top slicing relief calculation. And also there's been an awareness of top slicing is a relief. It wasn't just a kind of shorthand way of working out a higher rate tax liability. We know the Silver case occurred to do with chargeable events, chargeable gains, and poor Mrs. Silver was a classic case where she lost her personal allowance, and it was all a bit it was a bit muddy. And I certainly saw 3 different methodologies for calculating the tax on a chargeable event prior to the budget, with 3 different tax outcomes, which can't be right. We knew it wasn't right. We needed the clarification. Thankfully, we got it. Mrs. Silver had appealed previously against her tax determination, and she'd won. Mr. Silver argued the case, which I always thought was interesting, and the tribunal concluded they preferred the Silver's interpretation of the legislation, which is they should be allowed to have their personal allowance at the correct part of the calculation. So to me, what it brought out was planning investment bond surrenders really carefully to avoid this loss of personal allowance issue became very critical. And again, that's where working together, certainly with professions and with the financial advice profession, we can get into a really good position for clients, because I can't say it's quite easily avoided. I found a lot of the cases I was involved in were either people who were unadvised completely, or they'd made an emotive decision. Perhaps there was a house purchase involved or something like that, which is really time bound. So they hadn't engaged with the advisor or the accountant or solicitor to do the right thing and do the planning appropriately to avoid this Silver type situation. But it's really easy to get to the right place. Thankfully, we've got the clarification. We now get the personal allowance back in the top slicing relief calculation in the section where we look at the relieved liability, the average gain, which I'll just put up on the screen in a minute. But another critical confirmation was that offshore bond gains, which are taxed as savings income when we're doing the client's tax calculation, move up when we look at top slicing relief to be taxed as their top slice, complete top bit of income when we get to the top slicing relief calculation. And that can make a big difference for clients where we've got controllable or low income from a pension perspective. We've got offshore bond gains, or the ability to create offshore bond gains, which are very, very tax efficient. And maybe the client's got dividend income as well, because those bond gains will move in the tax calculation, and that can make a big difference for the client. So again, great clarification. The Silver case was proven to be the way to do it. The Revenue have withdrawn their appeal of the Silver case, and we wait to see whether all those clients that were affected before the tax year of the budget will get their money back. I tend to think they will, because it's a very difficult position to defend to not allow them to have it. This is the point I was going to make earlier. Again, just working together, we we can avoid this situation so easily if the client gets engaged, and we can engage with the client early and at the right time. Segment assignment, we know, is a fantastic feature of bond planning. Multi-segmented bond contracts, where we've got the ability to assign to other family members or interspouse. It's not for money or money's worth. There's no chargeable event implications of doing that, and to use other people's tax allowances to get the right outcome for the client. We could have looked at tax deferred withdrawals as a strategy. Would that give enough money by utilising those 5%? What about doing full segment surrender to just make sure that the bond gain just got them up to the 100,000, maybe doing it over 2 tax years? So loads of flexibility, or even paying a pension contribution to extend their basic rate band. There's a whole host of things we can do, and we should have avoided most of the silver type situations by just getting to those clients early enough to influence their decision. I'm not going to go into this in any great detail. Loss relief. The only thing I would say is, certainly from a financial advice perspective, it perhaps moves to the back of our thought process as we experience a bull market and clients seeing year-on-year return in their investments. IHT loss relief kind of moves back in the mind. Very forefront of the mind in 2007, 2008, when we had the financial crisis, the last big market correction. And of course, front and centre for lots of people now in the current situation, where we've perhaps had deaths that were prior to March, where the big market correction happened. But obviously, IHT loss relief is very, very relevant now in the right circumstances. So I think I saw some stats recently that said even last year, which was at the end of a 12-year bull market, it was still claimed 4,500 times. I wonder when the stats come out this year, how many times this will be claimed. I would suspect quite a lot, because it's a lot more flexible than just shares, as we know. The key points here are just it covers unit trusts and collectives, which is since 2008, the use of a unit trust and collective portfolio certainly became a very popular asset planning tool. Bonds tended to kind of take more of a back seat to a collective portfolio at that point in time because of the very generous capital gains tax regime. And still do form a big part of some wealthy clients' portfolios because of the very generous capital gains tax regime we're in at the moment. So there's a relief for IHT purposes, but again, we need to think about what may happen in the budget later on from a capital gains tax perspective, because I've heard talk of the capital gains tax exemption, which is currently very generous at 12.3, being cut to potentially £1,000 or even zero. So do clients with capital gains need to think about perhaps re-looking at their asset allocation in their portfolio because of the potential loss of that very, very effective relief and allowance? So there's some qualification criteria about IHT relief. You'll be more up to speed with this than I would be, but it needs to be done in the right circumstances, critically because of the 12-month period that you've got to do it, and they've got to be sold by the appropriate person. Very, very useful for the right client. We just use an example when we're talking about it to bring up the awareness in the advisor community. Just, a client who had £300,000 worth of shares, £120,000 of tax levied because that's the probate value as at date of death. Shares sold now, so within the 12-month period, 225, £75,000 loss, £30,000 worth of IHT relief. And the other point I make, which I think is really important, is we tend to see a lot of cases now where clients are what I call self-serving. We see a lot of lay trustees. We see a lot of people now who are doing their own probate. And the question I've always got is, do they realise that there's this significantly generous relief available? So they could be doing their own probate and losing out on an example like this, £30,000 worth of IHT relief. Huge believer in everybody working together and getting professional advice to make sure they're in the best position possible. It's not an insignificant sum of money. IHT planning in the current market environment it's very relevant. There's lots of people out there. We've seen this move towards intergenerational wealth planning. We've got this whole generation of clients that are the generation who hold the wealth, the baby boomer generation, which has been used for years and years and years. So they're now getting into that decumulation phase. They're realizing they're particularly asset rich. And I think with lots of things that are going on at the moment, they see the opportunity to pass wealth down currently, and see the next generation actually enjoy it whilst they're still alive, or they want some control over it but still want to do the IHT planning. Really, really important, huge area for advice at the moment, and a great time to be thinking about it. Market corrections make it a really good time to potentially think about that inheritance tax planning, and either could be direct or could be via trust, which a lot of people prefer because of the control aspect. And when I say trust, we shouldn't just be thinking of what I believe are the mainstream trust options that are out there. And I'll talk about that in a couple of slides' time. There's various advantages the client could get. The gifts are disposals. So you could be realizing a loss for the client, registering it appropriately, of course, within the 4-year time period. You've got to do that, carry it forward indefinitely for future planning. So that could be one bonus of planning at this stage where we've seen depressed asset values. And then if we can do that IHT gift at the depressed asset value, all of that growth, I think, it says in lots of slides, if there's a recovery in the market, but we historically have always seen a recovery in the market. All of that growth will be captured on the other side, and all of the growth will be outside of the estate for IHT purposes. So it's a great time to be thinking about those clients where you've had conversations about IHT planning and just re-engaging at this time, because there is significant advantage for them of doing it. If death occurs within 7 years of the gift being made, it's the original value of the gift that is included in the IHT calculation. So again, depressed asset value, the gift is lower. We've got more planning options going forward because we've used less of their nil rate band in their accumulation, assuming they've got some available. Quick example that we use, client was thinking about making a potentially exempt transfer to their daughter. After exemptions, it was 100,000. Because of the current market conditions, that the value of that asset that they were thinking of passing on has fallen to 75,000. They make the gift today because it's a really good time to do it. Used £25,000 less of their nil rate band, and you've got that 7-year clock ticking, which if we think back to the reviews that are outstanding, they're talking about getting rid of the 7-year clock and bringing it down to 5 years. So now is potentially a really good time to think about gifting because of the depressed asset values and the potential changes to legislation that could be happening. It says if the value of the gift recovers, let's be more optimistic. When the value of the market goes back up and the value of the gift recovers, all that growth is outside the estate. So very, very effective to be doing that at the moment. And again, context is everything. Although none of us can predict the future, if we could, we wouldn't be here. We'd be independently wealthy. We would have done something different. But there's those papers out there, and they're talking about getting rid of all these small allowances and exemptions and rolling them all up into one. And the suggested levels I've seen are between £10,000 if they exclude normal expenditure of income, but if they roll the whole lot up, including normal expenditure, into a £30,000 annual gift exemption or an allowance. You can't carry it forward. If we think back to the client we've just looked at, who was going to make either a £100,000 or a £75,000 potentially exempt transfer, they might not be able to do it if they implement some of the proposals from the IHT review, because in the all-party policy group it said £30,000 annual allowance, and anything over that is a gift will be immediately taxed at 10%. So they wouldn't be able to make the gift in the same way after the budget. So is it time to think about doing that now? I don't know. It's all food for thought. I use this slide a lot. You'll immediately, if you read the slide, realize what I'm talking about here. And it goes back to the point I made on the previous slide. Don't just think about direct gifts. Lots of people aren't comfortable making direct gifts to the next generation because they then have to look at the next generation spending what was their money, and there's a value decision problem sometimes with that type of gifting. I often say when I'm doing seminars, I wouldn't give £50,000 to my son because I know what he'd do with it, and you would need to make a decision as to whether that is value for money. Some people don't care. You could do it via trust, absolutely. All the normal trust structures that we look at to control both the tax and the timing of when the beneficiaries can ultimately get the money. But don't discount the pension scheme now. What's the most powerful discretionary trust in the UK? It's a pension. Tax relief at the highest marginal rate on the way in. You can effectively retain an interest in the trust and get some of your money back tax-free during your lifetime. It's not a gift for reservation. The death benefits are fantastic. We need to see whether that changes moving forward. But the death benefits from modern flexible pensions are just superb. So don't discount the pension. Lots of people now are looking at intergenerational wealth transfer and thinking about third-party pension contributions. And we've seen a huge increase in this type of thing because you're giving money to the next generation in a structured and controlled way where they can't get it until they're 55. And it's very tax advantageous. Just a quick example, somebody who is thinking about this, it's the right time to make a gift at the moment. It's the right time to do some intergenerational wealth transfer stuff. They've got an asset, and let's just pick a number. Let's say they had a collective portfolio that was worth £12,000 at Christmas. It's seen a drop in value. It's now worth £8,000. So they've lost some investment value, but they know they need to do some IHT planning. They can afford to give the money away. Why not consider making a third-party pension contribution and putting that £8,000 into, it says a child's pension, but we're talking about people who are in their 60s. So their children will be older in a lot of cases, not all. And could be working, they can't afford to fund their pension. So you put £8,000 in their pension scheme. This is an asset that was worth 12. You get basic rate immediately. So the gift gets grossed up to £10,000 in the pension. And then with that £10,000 that's sat in the pension, when the market recovers, all of that is sat outside of the original donee's estate. Or the grandparents' estate. It's outside, it's a pension contribution that's been paid in, all the growth plus the tax relief growing in a massively tax efficient environment and with a great death benefit, building up tax-free cash and income for the client when they retire. If they're a higher rate taxpayer, of course, they're going to get another £2,000 worth of tax relief through self-assessment. And that could be a real advantage in the current environment. Perhaps they need the money, they need some cash flow. So they've got the money tax efficiently into a pension scheme outside of their estate and given their child a bit of cash flow advantage. Or the child could choose to pay that money into the pension scheme as well, creating even more money in there. So it's a really good option at the moment. And we're seeing a lot of people look at this. And then you start thinking about intergenerational wealth transfer from a wider perspective. You could have clients, you know, who've got these pension schemes, and something that happened around 2015 was that people looked within their asset wealth to generate income in a different way when pension freedoms came in. Before, quite often, you would take the money from the pension scheme because the death benefits were very unattractive. If you were using drawdown, you had a 55% tax charge on death, which was just not nice. In the post-pension freedoms world, if the client dies under 75, then the pension fund, in most cases, in lots of cases, is completely tax-free for whoever gets it for the rest of their life. That's incredibly attractive. So clients actually switched and made the pension the last thing that they're going to take their income from. Now, lots of clients now are sat there with pension contracts or pension wealth that they're never actually going to tap into. They've got lots of other assets. They're generating an income elsewhere. They just don't need their pension fund. So could they start taking money out of their pension fund now and start utilising normal expenditure out of income? on a regular basis to take that pension income and pass it down into other people's pension schemes. Again, a great wealth transfer opportunity that is currently available. Normal expenditure is currently available. I think it's massively underused. You may or may not agree with me. And it's one of the things, the revenue, I think, have lost control of to some degree, because you've got modern flexible DC pensions. There's only 3 criteria, and there are precedent cases, as you well know, that establish the broad premise for it. So as long as we can satisfy those 3 things, it's habitual, it's got to be out of income, and there's a commitment to making this as a series of regular gifts, we should be good. Let's look at a very simple example. Again, just thinking about intergenerational wealth transfer opportunities, current economic climate, market correction. This pension fund could have seen a loss in value, but the client is never going to draw on it. They're going to pass it down as an intergenerational wealth transfer tool. Why not crystallize some of that money now? In my example, they crystallized 10,000. Because we're in this hugely flexible environment, we can create a situation where they're a basic rate taxpayer, because we can have up to £50,000 worth of taxable income. They're a basic rate taxpayer. It gives us a tax-free cash sum of 2,500, basic rate tax on the amount that's left, which gives you £6,000 net of tax. The question then becomes, how much could you gift under normal expenditure? Is it the £6,000 of taxable income? Is it all of the money? And the answer is, it's all of the money, the £8,500 that the client has. HMRC accept and have confirmed that money that comes out of a pension scheme is income in nature. That's the first thing it is, it's income. The second question is, how much of it is taxable and how much of it is tax-free? So pension commencement lump sum being phased out of a pension scheme satisfies the criteria for normal expenditure. And if you start thinking about that, that creates opportunity to pass money down through the generations. Using the child's pension scheme. Again, what happens for this client where they've taken £10,000 out of their pension and they've paid it into the child's pension as an £8,500 net contribution? Immediately it gets tax relief and is grossed up. So it's gone from being in £10,000 to 10,625. So an immediate uplift in value. And again, thinking about the current economic climate, all of the growth, when we see the market return, will be captured in the child's pension, which could help with maybe the grandparent's lifetime allowance position, for example. Again, the child will get tax relief. So in this example, the child higher rate taxpayer would get another 2,125, as well as the £10,500 in their pension fund, which they can spend, or they can make further pension contributions. So again, incredibly flexible wealth transfer opportunities exist in the current environment. And when we think about that, we don't just talk about third-party pension contributions. There's all the other mainstream savings options. You know, a bond in trust gives you lots of opportunity to get money out of the estate, to be IHT efficient. You could use ISAs, junior ISAs. You could use collective portfolios. There's lots of different options out there. Discretionary will trusts. Why would I be talking to professionals about something that they are experts in? Just trying to give some context as to why we believe at the moment discretionary will trusts are incredibly effective for first death planning. We tended to find that in lots of circumstances they kind of weren't used quite so much, I think it's fair to say, post 2008, when the transferable nil rate ban came in. Wonderful thing, transferable nil rate ban, very useful, quite simple to understand. Lots of clients take advantage of it. But why discretionary will trust, particularly now? I've always been a huge advocate of this type of planning since 2008 and before. But now, very, very useful for all of the reasons that we've got on the slide, which we all know. Control, all that kind of stuff. The big one, though, was the second point, which is growth. If we think about it, you've got the opportunity now to use that £325,000. And if we think about the growth over the next few years, in my example here, we assume the first spouse dies in this tax year and they don't use the nil rate band on first death via the discretionary will trust. So you've got an asset which is worth 325,000, goes into the estate of the spouse. If we see 6% growth, and bearing in mind we're in a position at the moment where we've had a significant market correction, and we could have ring-fenced this money in a discretionary will trust, either direct or via a deed of variation. If nothing had happened and it's still sat in the second death estate, it's going to be worth, at 6% growth in 10 years' time, 582,000. If we assume CPI growth in the nil rate band, and that's an interesting discussion facing into the budget at the end of the year, anything's on the table for tax change, but let's assume it still grows by CPI. Over 10 years, you would expect the nil rate band to get to 400,000. That gives you £182,000 of asset growth that isn't covered by the transferable nil rate band, which gives you nearly £73,000 worth of IHT. If we'd taken the opportunity just to drop that into a discretionary will trust, now with depressed asset prices, all of that, of course, would be within the trust and would be outside of the second death estate. The whole 582,000, and we could have used loans to assist with further IHT planning, all the good things that we can do with discretionary will trusts. So my point is, you will be very au fait with obviously this type of planning, but the advocacy from our perspective at the moment is huge, because the opportunity now in the current economic climate for this type of planning, I think it pushes it right up to the forefront of the conversation when you're talking about estate planning with clients. Certainly something I talk about all the time. And there are advantages depending on how the discretionary will trust is set up. In the traditional way through the will, the value goes into the discretionary trust. The asset then in the discretionary trust is taxable at the rate applicable to trusts, which we know is quite significant. And even if we were looking at a life assurance or capital redemption bond chargeable event legislation, we're talking about a 45% tax charge, where we may or may not get tax credit, depending on whether it's onshore or offshore. However, there are options, and we could knowingly use a deed of variation for a client, where you've got people who we are reasonably certain will be basic rate taxpayers on the journey moving forward, and we can generate some tax control, because we do the nil rate band trust via a deed of variation. So we do the discretionary trust via the deed, which then makes it settlor interested from an income tax perspective. And when we need to encash the bond at a time in the future, we can obviously use the settlor's income tax position to maybe avoid some of that rate applicable to trust 45% tax charge, because the original settlor for income tax purposes is a basic rate taxpayer. So again, lots of options, lots of opportunities that we're talking about with clients from an estate planning perspective around this. I just want to talk about loan trusts, which again is a classic and a well-known opportunity with the revenue. The revenue have seen this type of trust structure. They're comfortable with it. It's been tried and tested. Why would you think about loan trusts at the moment? You know how they operate. The loan is made. The beneficiary or the settlor retains the right to the loan repayments, repayable on demand, quite often used to produce an income stream. In 50% of cases, in my experience, an income stream isn't set up at the start, and the client wants some capital access. That's the beauty of this type of trust. They've got capital access. And then you go and have a conversation 4, 5, 6 years later, and they still haven't accessed it for the reason that they thought they did, a holiday home or a yacht or something like that. And they're 5 or 6 years down the line with the same inheritance tax liability on that capital that they think they wanted access to. So loan trusts, underused, I believe, but it's a great time to be thinking about them at the moment because we've got those depressed asset prices. So loan trusts, which we're comfortable with, we know that it's the growth aspect of it that is the IHT efficiency. The original investment, that loan repayment, is always subject to IHT for the set law. It's the growth. But if we think about the fact of a depressed asset price, we could retain that access for the right client, and the income stream we can turn on immediately or sometime later on. And all of that growth is captured outside of the estate in the loan trust structure. So efficient at the moment. Lots of clients don't do it because I'll just use a quick case study, and then I'll just stop after this and we'll take some questions if there are any. So this is a client who was thinking about doing some IHT planning. Not untypical situation, higher rate taxpayer, estate liable to IHT. She had invested 100,000 in a FTSE tracker fund, onshore bond. In January, pre-market correction, that bond was worth 134,000. So we've got a chargeable event and a potential tax liability because she's a higher rate taxpayer. Can't just assign the existing bond in. I'm not saying that there isn't a loan trust structure out there that wouldn't take an existing bond as an investment, but traditionally they won't take them. You have to set it up with cash. Certainly a structure that a life a life company would offer would want a cash asset to then invest in a bond. So it's not a transfer value for IHT. We've got to think about periodic charges and that kind of stuff, although that's not too difficult to deal with within loan trusts. And again, thinking about the context, there's still an outstanding review from the Office of Tax Simplification around the simplification of the taxation of trusts, which we're expecting some output from at some point. And you know, loan trusts can be very efficient in the current climate. This client, they had a bond that was worth 134,000 with a potential tax liability of £6,800. They decide not to go forward and do the IHT planning because they don't want to incur a tax charge currently on this asset. But market correction, if the market's gone down, the bond now could be worth it could be worth about what they invested, maybe a bit less or just a little bit more, where we can manage that situation with their chargeable event. In my example, there's no chargeable gain. We can surrender the bond and reinvest the proceeds into the loan trust, and we can now capture all of that growth when the market recovers in the loan trust structure, knowing we've still got access to capital and income if the client needs it at some point in the future. So well worth looking at. We know they've got access to capital. We know they've got access to income. I just want to go back to a point that I made earlier around, I believe, and from stats that I've seen, having worked for companies that operate these for a number of years, broadly 50% of people set them up with income streams and 50% of people don't. And then you get 4 or 5, 6 years down the line, have the conversation, client doesn't need the capital. Well, at that point, we've got the option in most of the trust structures to do a deed of waiver. So they can forego their right to their loan repayments and effectively gift it into the trust, which leaves the money in the trust. And instead of them taking it out and trying to do some IHT planning with it, which could cause a chargeable event problem in certain cases, they can just waive their rights to the outstanding loan. Done via a deed, very effective planning. And you know, this is used quite a lot now within this type of structure. That gives us the advantage of all the growth outside current market and the potential to do this phased deed of waiver to deal with the IHT as they go through the journey. Some clients do it with their £3,000 annual exemption, but to be fair, for most clients that's never going to solve their problem. And will that even be available after November? Don't know. So it is done in a few circumstances, but it's never going to solve the issue the client's got. So deed of waiver is very, very flexible. It avoids the need to encash the underlying investment and possibly get a chargeable event. and the money stays in the trust for the benefit ultimately of the beneficiaries, where we can again do some flexible tax planning as and when the money is required through appointment or segment assignment, depending on the right way to do it, or encashment in the trust if that's the right thing to do. So very, very flexible, and that goes right through to the death of the settlor. And just making sure it's documented appropriately what happens with the outstanding loan repayments on the death of the settlor. Is the loan recalled by the estate, or are those loan repayments left to somebody else in a tax efficient way to create some further advantage? So I think, just to sum up around this section, that loan trusts currently are very, very attractive for lots of clients in the current IHT environment. And we see them being used quite extensively at the moment. So the question now is, when's the best time to do one? Is it when the market is high and at the back end of a bull run, or after a market correction, when we can do the appropriate planning and then capture all that upside with all the flexibility within the loan trust structure? So I'm going to hand back now and hand back to the host. And if there's any questions, he'll then ask those questions. If I can answer them, I will. If I can't answer the question, then I'll just body swerve it, push it back on the host, and we can watch him deal with those tricky ones.
Thank you. That's very kind, Andy, to do that for me in advance. I can't currently see any questions in the chat box, so we've both got away with that, should I say, in a nice way.
Okay.
Oh, yes, Danielle, we can send out slides. We're also recording this webinar, so if you want to watch it again, you can do that. And there's someone is typing, hopefully a question. So this one is addressed to you, Andy, so no swerving, sadly, but it says, what's your thoughts on the autumn budget changes?
Great question. A very interesting question. I used to do a lot of press work for a previous company, and I used to get asked this question by journalists just before every budget. And I have to say, which is probably a bit of a cop-out, I used to have the same article that I just used to change the date on every year. They thought I was really efficient, because the point I'm trying to make is we all talk about the same things being up for review, the same 3 or 4 things. Will they get rid of tax-free cash on pensions? I think that's far too emotive. I do think, however, if I was going to give my thoughts, I think capital gains tax, absolutely. It was always my belief that capital gains tax was going to be looked at. Because it is a tax on the wealthy, and particularly in light of the current situation, there's talk about a wealth tax, which may or may not happen. I tend to think not. But I do think tax on wealth, which is capital gains, will be looked at. And that could be quite significant, as I've referenced in the previous slides. The big, if you were a betting person, the big kind of favourite at the moment is scrapping the triple lock on pensions. Now, that is massively emotive, because if we think back to the election campaign, if you wanted to attract the vote of the older generation, the 3 things were: you had to guarantee the triple lock on pensions would stay, the winter fuel allowance, which seems very emotive for people, and a free TV licence. My dad keeps moaning that they're taking his free TV licence away, so I don't know what he'll do if they scrap the triple lock. But that is the big bet at the moment, and they reckon that will raise 20 billion. I do believe, and this isn't scaremongering, I do believe, as a personal opinion, that if ever there was a time where they could deal with higher rate tax relief, it's now. They've got time to think about the implementation of it, which has always been the difficult thing. So I think triple lock, I think higher rate tax relief on pensions is right in the crosshairs, as is capital gains tax. And we know that there's been this significant raft of consultation around inheritance tax. And all of those are low-hanging fruit and affect higher net worth investors. I go back to my previous point, though. Whatever they bring in, there will be opportunity to do effective tax planning for those clients. Hopefully that is a decent answer to the question. But I think this autumn budget could be very far-ranging, far-reaching for our target group of clients.
The next question we've got is, do you feel there'll be any penalties on having an offshore bond in the budget?
Again, good question, Tony. Do I think there'll be penalties? No, I don't. The revenues seem really comfortable where they are. If you look at the Insurance Policyholder Taxation Manual, they're very comfortable with offshore bonds as an investment structure. They're very highly regulated. They're as highly regulated now from a tax perspective as an onshore bond structure, so a UK-based bond. I work for a business that offers an offshore bond structure, and we are effectively a fiscal representative for HMRC when we look at tax liabilities from bonds. So I don't think there will be tax penalties for offshore bond structures held by UK investors, because the way that tax that's levied on them is incredibly robust. So that's my view. And I don't believe they would try and do that. It would be very complex again, and we would be getting into anti-avoidance type territory for them to try and police it. They're quite mainstream, I believe, now.
Yeah, perfect. Thank you. Well, I can't see any other questions, so I'd like to thank you, Andy, for taking your time today to present to us and everyone involved. If anyone does have any questions after we end this in a minute or so, please do email myself or Natasha at Beaufort, and then we can, if it is a question for Andy, we'll pass it on. And if it's one of us, we'll come back to you. But thank you, everybody, for taking your time, and thank you very much, Andy. And I hope you have a good rest of the week.
Thank you.